thank you all so much for your confidence in us and your attention and your continued partnership. I'm going to start with just a high-level market overview. So Q3 in review, and then talk about what we see moving forward. Q3 was a strong one for markets. People don't always contextualize what's going on, but if you look at what's gone on this year in the stock market's up more over the first 3 quarters this year than any year since 1997. Bond markets just had another phenomenal quarter. Bond markets generally don't have great quarters if inflation is going to be out of control. Bond market was up 5% and change. That's the second best quarter for bonds in the US in, I think, 29 years. So things are going really well out there, despite all the hand-wringing and people's concerns about frothy markets and everything else. Markets are making new highs. Leadership appears to be rotating. Things appear really good. So the key story last quarter was synchronized global central bank easing, starting with the ECB. The second rate cut was actually in September. Second rate cut in approximately 3 months. Then about a week later, you had the FOMC cutting 50 basis points. And then followed by that, you saw the biggest stimulus package from China since the global financial crisis. So we have synchronized global bank easing. That reminds me actually of the Chinese situation. I imagine that's going to be a question on many investors' minds. Are we buying Chinese equities? And the answer is no, we're not buying Chinese equities, partially because I'm still licking my wounds from the Russian situation 2 years ago. So that was a situation where there's really no good reason, from my perspective at least, to delist equities. Think about China, the same thing could happen there easily. And you hear Ray Dalio saying, who's been a China bull forever, saying China is a little tricky right now. And you see major international corporations pulling out of China. We don't want to have things with zero risk in the portfolio. We think there's other ways to get exposure to that, those types of valuations, whether it's or depressed prices, whether it's through coupon or small caps, even domestically. But yeah, that market was up 40% in 3 weeks, which is incredible. But again, we're scared of the geopolitical risk there, and so we are staying away. We think there's other places to take prudent valuation risk. Outlook in general, though, let's talk about moving forward. It's pretty solid. We have low unemployment, and the most recent rating just came down, causing some people to question the 50 bips cut. I don't question it at all. I think that was the right move, and I still think the neutral rate is lower. So you're going to see noisy numbers around inflation, but the reality is it's coming down. Bonds are doing well. High rates work, and things are moving along, and everybody has incentive to keep it together. A lot of people have been keeping their money on the sidelines, nervous about a potential hard landing. That hasn't worked, never worked, very rarely works. Reality is, we've called this out in the past, that the market will sniff out those situations long before any individual actor most likely can. So that's why our approach is always to just look for securities that have low embedded expectations for the future, and own them until the market comes around to our view of what we think they're worth.